All right, welcome to intermediate module 2. And here we'll be talking about support and resistance. The previous part, the first module of intermediate, we spoke about market structure. So here we'll be dealing with support and resistance and how it affects or how it syncs with market structure as well. So what is support? Support is a price area where buying pressure is strong enough to stop price from falling further. Right, price reacts upward from this zone, shows demand is greater than supply. So when you hear demand is greater than supply, that means that there is buying pressure. That means if you say a fan is in higher demand, that means that there is no much supply of that fan, and people need it a lot. So demand is what leads to price of a material surging up. Everybody needs rice, but there's no rice in the market. Maybe farmers are not bringing rice to the market. The price of rice could increase. But when there's supply, then when there's excess supply, right, that means people are not the value will drop. All right, everybody has it, so it's not something that is rare. That's why they say the things that are precious are the things that are rare. So it's in essence, all right, it's everywhere, so it loses value and depreciates. That's why we speak about resistance. But demonstrating what support actually means on the chart is something like this. Now if you're looking at this, you see that price kept from here, went up, came back down, went up, came back down, went up, came back down. So you can see that this zone, support is actually a zone, not a line. This area serves as a source of a floor. That means that once the price comes back to this area, it eventually still bounces back up. Alright, that means that there's a lot of buying pressure from this area. So understanding resistance is typically just the opposite of that. That means that there's a lot of selling pressure at this area. So whenever price comes back here, there's a high tendency for it to reject almost immediately. When it comes back, there's a high tendency for it to reject almost immediately. You get? So that's a typical example of support and resistance. Resistance is a price area where selling pressure is strong enough to stop price from rising further. Price reacts downward from this zone. How supply is greater than demand acts like a ceiling. Alright, resistance is also a zone, not a line. Now, the role reversal. This one is very important. This is where it matters in market structure. So support becomes resistance. Alright, they change role. It's just like the support dies and is bound to become resistance. The resistance dies, it's bound to become support. So price breaks support, comes back to retest it. Old support now acts as resistance. Resistance becomes support. Price breaks resistance, retest it. Old resistance now acts as support. This is where high probability entries happen. That is how I explain the market structure and how you can find your entries. So, like I said it's dealing with market structure. Alright. So market structure is a upward movement. Market structure has building blocks of higher highs and higher lows. Alright. So how remember it says that this is where high probability entries happen, right? So looking at how an upward structure will happen, we said we wanted to see a low to a high, then wanted to see a retracement, which should eventually become a higher low. They want to see a break of structure. All right. So it said for the resistance becomes support. Price breaks resistance, retest it. Old resistance now acts as support. Alright, this is where high probability entries happen. So while going up, alright, we're dealing with resistance. If we're coming down, we're dealing with support. So back to the resistance, we know that a break of a high or a break of a low is referred to as a break of a structure, and either a high or a low can be formed. That means that is either a resistance or a support. Now this is a high, so that's a resistance. That means price reacted from that area. That means there was some sort of buying pressure from that end. So that makes the zone significant somewhat. Right? So and when price now rises further, it breaks the support, alright, and comes back to retest it. Mostly we want to find price coming back to retest it before buying again. And for some weird reason, 80% or 70% of the time, we're trying to see if our retracement is valid. It also ends up falling in an area where the old resistance, if you extend that line, you see that it now becomes what, new support. That means the period, the selling period that was here has now become a what, a buying pressure. All right, that's change of role reversal. All right, that's why we see that what you want to see once you're trying to like catch a trade is that you want to see this move happen. You want to see retracement. If you're lucky to see it as clean as this, most of the time it doesn't, like I said, market does not give clarity, so it doesn't happen as clean as this. But sometimes you see it like this, as clean as this. You see price retraces back, same zone as this old resistance, now becoming a support in the golden zone of Fibonacci. And if you draw your trend line, you now found out that what they align, you get, so everything just sticks. These are high probability trades. These are trades that you move with confidence, right? You act immediately. Because it's a high probability trade does not mean that what, it can't go against you. It can still go against you, but the chance of it going against you is low. Unlike a regular trade that still has higher risk, because a high probability trade means that what, you must have checked a couple of options and seen that your confirmations are aligned. So okay, so explaining that, we've explained the support, the becomes resistance, price breaks, support. That's the opposite of, that's a downward structure actually. So you understand that by withdraw, want to see something like this, like this, like this, then our support, which was L there, now becomes a new resistance, because what, eventually price would, after breaking through, price now comes back to what, to retest it before coming back down again, right? So it's just typical explanation of how support and resistance syncs with market structure. Then this is a more detailed explanation. So in an uptrend, support is equals to what, higher lows, price respects support, the trend continues, you buy near support, right, only if structure is bullish, right? In a downtrend, resistance, right, is equals to the what, the lower highs. That's in a downtrend. The resistance is what, is the lower highs. Price respects that resistance, trend continues, sell near the resistance only if structure is bearish. All right, you see how we're keeping it in shape. You want to what, you want to buy near the support only if the structure is bullish. You don't want to be selling when the structure is bullish. All right, so that keeps you in sync and keeps you from unnecessary trades. So how to draw support and resistance? So number one, you want to use major swing points. You want to draw from a clear high and low. You want to ignore the small noise. You want to focus on the main points of rejection. Then multiple touches matters. The more price reacts at a level, the stronger it is. Then use bodies plus wicks. Don't force precision, mark the reaction area. Alright, you want to make it simple and clean. So you can see one from USDJPY that I did here already. So but I'm going to pick let's say I'm going to pick a random pair. So drawing my major swing point is always on the high time frame, like the daily and the 4 hour. So focusing on the current price action, I want to draw my swing points, focusing on what was happening or what I'm seeing at the market at the moment. Alright, so for the past 1, 2, 3, 4, for the past 4 days, this is what we've been doing. So you want to focus on the major areas. Now you see that price reacted from this zone, bracket, that zone, similar here. It's just that here came back a bit, and I see that reacted from this zone, something similar there, something similar here. So you want to use what? We want to use bodies and what? We use bodies and what? Bodies and wicks to draw your zones. So I draw mine like this from here, shrinking it a bit, bringing it down. All right, trying to catch all those touches without making it seem excessively near. Then repeat that. I'll leave it here. All right. So this is how I draw my major zones. Now, quick point. Looking at this, I haven't traded AUD USD before, but this rejection from here, from this previous first point, and the neckline has been broken, shows that the market might continue going downward, but that's just the side of it. So we were trying to catch up with this. So we've explained how to draw support and resistance. You want to focus during your support and resistance. It depends on the type of trader that you are, but you want to focus on what you want to focus on the things that matter. If you're a day trader, you want to know you want to start from 4 hours a daily. Then if you're a scalper, there's nothing you're looking on the 4 hour. I think the max you can go is 1 hour. Maybe your zones should be drawn on the 1 hour. Right, so you don't want to go drawing zones when you're looking for tiny moves. You're not drawing zones on a higher time frame. It won't make sense. So breakout. What's a breakout? A breakout happens when price closes clearly beyond support and resistance, shows strong momentum, accept price above resistance or below support. Alright. The key characteristics of a true breakout: the strong candle close beyond the level, follow through, price keep moving, often followed by a retest, structure aligns with the breakout structure, with the breakout direction rather. So example is that resistance breaks, price retests the resistance, alright. Then what resistance becomes support, the trend continues. That's what we call a breakout. So that why if you're trying to trade a breakout, you always want to wait for a retest. Looking at this AUUSD, if price eventually close, this is a zone that support and resistance. When you call a breakout is something above a support or below a support or above a resistance. So if this candle eventually closes with the full body, not this week, you can see that here is just a week. So if it closes with the full body below here, alright. So I want to see a retest of candle. I want to see let me draw what I like to see. So I want to see something like this candle closes here, something like this, then a retest back to the zone, then what continuous drop. So you see it on a more visible uptrend market or downward market something. Now you look at this very structure, you see that this was the old support. The support, alright, this was where price came down to this area before the retracement, it now broke structure. Alright, so you want to wait for a pullback to the sense, and then fall. Now the thing is that when this thing is happening, except you're excessively high on the high time frame, when this thing happened, if you go to the lower time frame, because you can see that this retracement took the breakout happened. So after the first day of the breakout, the retracement took 1, 2, 3 days before happening. You don't want to wait for 3 days for a retracement to happen. So in the lower time frame around here, there's always another structure forming again with the retest following the same alignments. Alright, for every structure there's a structure inside. Right, there's always an internal structure inside, and that internal structure is still another internal structure. Structures are just made up of structures. I don't even know, but that's just it. If a break is supposed to happen, it will have started from the internal structure already. You would have seen it. If the trend is supposed to continue, you would have seen it. Alright, so just follow your analysis. Just because you are seeing it early does not even mean that it will still happen. Market will still do what it wants to do, but it just has to be sharp. Okay, so that's it for explanation of breakout. So fake out, this is what you want to run away from or use as an advantage. So a fake out happens when price briefly breaks a level. Alright, it triggers stop losses. They call it stop loss hunt or whatever it is they call it. Then it quickly reverses. This is called liquidity grab, stop hunt, fake breakout. Alright, why it happens? Smart money needs liquidity. Retail traders place stops above resistance or below support. Price goes there to collect orders, then reverse. Alright, it's more like you entered at the wrong point. Is an early entry, or not early entry rather. I think a wrong entry that causes it. Sometimes you could even still be right and still be taking that as liquidity, So liquidity happen when price intends to break a zone but did not. This is an example of a liquidity. Yeah. Alright. Yeah. So you can see price rushing up. There are a lot of momentum traders. So when they see price going up, right, everybody's pressing their. When they see price out above here, a lot of people are pressing their sales because they're trying to they're pressing their buy rather because they're trying to catch early entry. Alright, another price does that. Alright, their stops is below because this is typically how their buy trade will be. Let's say they entered somewhat around here and their stop was below this around that time, and they're targeting 1 to 2. Right, so you can see what price the price would have maybe put them in a little bit of profit and then time almost immediately. All right, so price literally just goes there to collect orders. Smart money needs money. Just collect a lot of people money and just thanks. So we call it stop ons. That's how it makes sense to people sometimes, but it's just liquidity. So how to tell the difference, all right? How to understand between an actual breakout and a fake out, all right? Number one is that you want to look at the candle close. You want to make sure that the candle is closing beyond a particular level, either above a resistance or below a support, all right? So that's a possible breakout. If it's just a wick, all right, if the candle just like visits that area, but at the end of the candle close, it didn't close beyond either below or above that particular zone, all right, it closes back inside, all right, that's a fake out. And you don't want to trust that type of trade. But there was this time that I was trading support and resistance, and whenever I saw a fake out on either a support or resistance, I just knew that price, if I saw the fake out clearly on the support and I was lucky enough to, maybe at the time I wanted to enter, that sale just happened. Maybe I was trying to buy on the support, but it just tanked and I was able to just enter just like that. So when I found out that the candle eventually closes below inside that zone, and I take a buy, it most like 70% of the time it eventually breaks the resistance and continues with buying. Same thing for the resistance, all right? It continues selling and breaks the support. So it's just like the liquidity grab is just more like energy for the market to just continue pushing higher. So the second rule is that you want to check market structure, right? Break out with the trend. You want to understand, are you even trending up, right? So if you see that there's a breakout, break of the resistance going upward and it's still above the bullish structure, as a very probability that breakout might even happen, right? If it's breakout against structure, it might just be a fake out, right? You just want to be cautious, put the things at the right path. So number 3 is that you're waiting for a retest, you're entering on the break, all right? So if you're entering on the break, it's quite risky because the candle has not closed there. That's why I said before, most of the time before I take my trades, I always wait for the candle close. If I'm looking at the 1 hour, I want to wait, okay, this 1 hour that's catching my interest, let me even see how it closes eventually. Most of the times you want to wait for that particular candle that you're looking at to close, all right? You are never too late. A trade that is for you will be your trade. So you want to wait for the candle to break above that zone, then you want to wait for the market to retest that zone. That shows a confirmation, all right? So after it touches that zone, it gives you a confirmation to entry. Usually happens on the candlestick. That's when you now see either a bearish engulfing or a bullish engulfing. All right, you find the candlestick pattern that you used to enter that type of market. So the golden rule is that price breaking a level is not enough. Acceptance beyond that level is what matters. All right, you see price breaking a resistance, you want to see it going upward. That's how you know that. That's how you know a true breakout. Look at this place. So what happened? All right, price broke this. Oh, let me just use a second move. Okay, look at this one. I think this is the second time price was touching here. So you can see that price broke. Look at this huge engulfing. Price broke down. The lot of good that already started selling already, and look for what price to return back almost immediately. So so I think that's the end of the slide for module 2, and I'll see you on the next one.